In 2025, a single financial product drove the vast majority of global crypto trading, surging to an $85.7 trillion volume. But almost all of that capital flowed through offshore exchanges, operating entirely outside the reach of U.S. regulators. This chart tracks the global volume of perpetual swaps, being the primary engine for price discovery. U.S. participants have been legally barred from trading them on domestic platforms. That regulatory firewall meant the most heavily traded, highly liquid financial instrument in crypto existed almost entirely as a gray area offshore game. To participate, capital had to leave the protections of the U.S. financial system. For years, American capital has waited on the sidelines of the industry's most active financial engine, waiting for the first breach in the regulatory dam. These contracts are more efficient than legacy futures and options because they remove the friction of monthly expiration dates. In traditional markets, traders must constantly close and reopen, or roll over, their positions, incurring recurring operational costs and management overhead. A perpetual contract eliminates the expiration date entirely. It allows a trader to maintain a leveraged position indefinitely without ever needing to settle or roll it over. This split screen shows the shift. On the left, legacy markets operate on a ticking clock. On the right, perpetuals use a mathematical tether called a funding rate. Because there is no settlement date, the funding rate rebalances every few hours to force the contract price to track the real-time price of the asset on the spot market. When demand is bullish and the perpetual price trades higher than the spot price, traders holding long positions pay a recurring fee to those holding short positions. This incentivizes sellers to enter the market, compressing the premium and re-leveling the scale. When demand turns bearish, the mechanism simply inverts. Shorts pay longs to balance the discount and keep the contract tied to the underlying asset. By replacing physical settlement with this continuous exchange of fees, the market gains a highly liquid primitive. It is an architecture designed for 24/7 automated trading and precision hedging. The offshore monopoly ended with a sudden regulatory breakthrough. The CFTC granted approval for Kalshi to list the first true domestic Bitcoin-referenced perpetual. At the same time, Coinbase secured a regulatory no-action letter. This allows them to route American traders directly into global offshore derivative markets, effectively connecting U.S. capital to the world's deepest liquidity pools. These combined approvals shift perpetuals from a gray area experiment into a regulated mainstream component of the U.S. financial landscape. The opening of the domestic market has triggered a race among well-capitalized players to capture the resulting vacuum in market share. Prediction markets like Kalshi moved first, demonstrating that the line between information betting and hard crypto primitives is rapidly disappearing. Centralized giants like Coinbase and Kraken are deploying their existing infrastructure to onboard retail capital, while decentralized powerhouses like Hyperliquid are establishing footprints in Washington, D.C. to prepare for a compliant domestic push. The incentive is the high-margin revenue generated by derivative fees. Even at only 2 to 5 basis points, the sheer scale of tens of trillions in notional flow makes derivatives the primary revenue driver for the world's largest exchanges. The platforms that capture this early domestic volume will secure the most lucrative fee-generating engine in the industry, effectively anchoring the next generation of U.S. crypto liquidity. Because a perpetual contract only needs a reliable price oracle to function, it is starting to expand beyond crypto to reference any asset with a verifiable price. We are already seeing this expansion into real-world assets. Platforms are deploying perpetual contracts for non-U.S. gold, silver, and stock indices, bridging on-chain liquidity directly with traditional asset classes. This chart reveals a massive structural gap. Traditional U.S. equities are only open for trading about 3.6% of a calendar year. Perpetual contracts provide a 24/7, 365 trading rail that never closes. While perpetuals still rely on spot markets for price anchors, the always-on nature of the perp makes it the more attractive venue for active risk management. As more volume shifts to these continuous rails, the legacy spot markets risk losing their status as the primary venue for price discovery. But this growth introduces a structural danger. When 90% of volume comes from derivatives rather than spot trading, the market becomes dangerously top-heavy. High leverage combined with thin underlying spot liquidity can create a feedback loop where a single large liquidation triggers a rapid, uncontrollable price collapse. This was recently demonstrated in a flash crash of the hyperspac USD perpetual. A single oversized position in a low-liquidity order book wiped out roughly $1.5 million in notional value in just 30 minutes. Regulators worry about these mechanics because they show how a small, missized position can have an outsized impact, a risk that becomes systemic as perpetuals begin referencing more traditional, macro-sensitive assets. Navigating this market requires platforms to move beyond simple listings. Success depends on ironclad risk controls, dynamic margin models, and circuit breakers that can pass institutional regulatory scrutiny. The winners of this onshore gold rush won't be the platforms that chase the most volume, but the ones that can safely domesticate an inherently volatile, always-on financial beast.